The Bank of Canada and the Federal Reserve Bank today both did the same thing, which was a whole lot of nothing, defying the odds and putting in question what the next few months in the economy look like.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
All right, so welcome back. Today we're discussing the Federal Reserve Bank in the US and the Bank of Canada and how neither of them made an increase to interest rates today, although they did provide a pretty clear path forward. And at the end of this video, I want to discuss the path forward for you if you've got a variable rate mortgage, because obviously there's a lot of people who are expecting that now should be the time to lock in since we know that interest rates are going to go up, but not so fast. There's some things you need to understand about how interest rates work and about what it would look like if you actually locked in before you make that decision. But before we get into the video, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where when we hit 25,000 subscribers, we are going to give away $5,000 to one lucky winner to do with whatever they like. But you have to be subscribed to win. Oh, and by the way, if you have a mortgage, if you're thinking about locking in, it's probably a good time to start shopping. Just don't lock in with the lender that you're at, because there's a pretty good chance that there's a better deal out there with another lender. But before you start shopping for another lender, you need to know exactly what the potential landmines and surprises are with discount mortgages, with bank mortgages, and with virtually every type of mortgage that's out there. So we have put together a course called Secrets to Getting the Lowest Interest Rate that gives you all the information to basically make sure you don't get screwed by a lender and don't have any sort of landmines today or surprises 3 or 5 years down the road, like a high penalty that costs you $25,000 or $30,000, or the inability to move to a different lender, and so on and so forth, which can make it really difficult if you decide to lock in at some point. All of those things are covered in that Secrets to Getting the Lowest Interest Rate course. You can go to ratesecrets.ca to get it for a very, very, very low price as of right now. We will be increasing the price on that course, but we have made it so cheap because we want to make sure that everybody has the information they need as interest rates start to rise in order to make sure that they get the absolute best mortgage for them. We discuss all the things like how to negotiate with a bank, how to negotiate with a broker, how to negotiate if you're an existing client and you're not just getting a new mortgage, and so on and so forth. So go to ratesecrets.ca to get that course. And by the way, if you decide to choose Mortgage 360 for your mortgage, you get 10 times your money back and a credit just for signing up for that course. So go ahead. It is totally worth it. And most people who take the course, even if they don't end up dealing with us, get 10 to 50 times their money back. So let's discuss interest rates. Let's discuss what's going on. First and foremost, Federal Reserve and the Bank of Canada both held pat on their basically emergency interest rates. They put it into effect back in March of 2020. This kind of came as a surprise, kind of wasn't a surprise. I would say if the markets didn't have the bad week that they had last week, we might have seen a different outcome here. Although the Bank of Canada has been clear that they are trying to do everything they can to make sure that they provide clear and concise forward guidance and that they don't surprise the market. Because obviously a few years ago, what happened, when I say a few years ago, I mean going back to the early 2010s, was both the Bank of Canada and the Federal Reserve in the US surprised markets when they increased interest rates. Most of the markets didn't see it happening, and it led to bigger issues that ultimately had a major effect on the economy. So this time around, it appears that they're going to be very transparent, and they're being transparent in their own words to make sure that monetary policy is a source of confidence, not a source of anxiety. So they're basically saying that any moves that they make are going to be forecasted well in advance, and they forecasted today that they're probably going to increase interest rates come March, and along with a bunch of other things that are generally going to happen in the next little while, it is seeming like March is inevitably when interest rates are going to start to go up. Now, that being said, March 6th is an eternity away, especially in the era of Omicron and the era of COVID. So we're yet to see what will happen over the next 30 to 35 days. And honestly, it's anybody's guess what happens in the next 30 to 35 days. If the stock market tanks, if numbers stop looking as good as they look right now, we could see something totally different. But for right now, expect that interest rates are probably going to go up around March 6th in Canada and around March 16th in the US. Now, what does that mean? Are fixed rates going to go up? No. Fixed rates generally already have the increases built in. So if you're in the market shopping for a mortgage, you're already probably locked into a rate hold that's pretty similar to what the interest rate is going to be in March. So there's no need to rush in and buy a house because you think you're going to lose your rate hold. You're probably okay there. But variable rates, it seems will increase. So that means variable rate mortgages, lines of credit, any type of mortgage that's tied to prime. Now, I wanted to jump into the headlines here just to take a quick look. Show you the headlines. First and foremost, BNN Bloomberg, Bank of Canada holds rates despite surging inflation, defies the market. I love that headline. We got Rob McLister here talking about the fact that the Bank of Canada is just delaying the inevitable. Obviously, they're delaying the inevitable to make sure that Canadians have a clear line on what the future looks like. They don't want to spook the market. But they did put Canadians on notice that interest rates are going to go up in the very near future. And again, we can expect that sometime in March. Now, I want to show you what's happening in the US because this plays a big factor in here too. First and foremost, if you take a look at the Dow Jones Industrial Average, after the Federal Reserve Bank in the US said that they're holding pat and indicated that they're probably going to move interest rates around March and start reducing their bond portfolio, the Dow Jones lost about 129 points at the end of the day. It was down as much as, well, as far as I saw, about 355 points. I bought in a little bit at that point today. And you can see that S&P was down slightly, NASDAQ's up. This is partially due to positive earnings for both Microsoft and Tesla, which were both positive on revenues and profits. And then you can see still this VIX, which is the volatility index, is up slightly over what it was yesterday, meaning that the market seems to be a little bit more volatile without the rate increases that were expected. Now, I want to show you here real quickly, the Federal Reserve points to interest rate hikes coming in March. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. The central bank said in a statement that concluded its 2 days meetings this week. And then I want to show you real quick as well how this affected the Canadian stock market. Basically, the market was up early in the morning after the Bank of Canada announced, and then near the end of the day, it came down. Not sure what happened there, but nonetheless, interesting things happening. So I want to take a look here real quick and point out some of the key metrics in the monetary policy report. So what I'm going to do is I'm going to take you in and I'm going to show you this report specifically here. And if we go in and take a look, this is the monetary policy report. This is what we were looking for with respect to the Bank of Canada's outlook on the economy and the worldwide economy. It has quite a bit of information in it. If you are an economics nerd like me, it's interesting. If you're not, I'll just give you the highlights here. I outlined a few things as we went through this. And, first and foremost, I would think it's important that if you are in the market for any sort of mortgage or you're worried about inflation control and everything else, the inflation control strategy is always at the beginning of this report. And it talks about everything about their monetary policy tools, inflation targeting being symmetric and flexible, and monitoring inflation and so on and so forth. And then it goes into the actual monetary policy report. And I want to show you some of the overview pieces here. So first and foremost, I thought this line was interesting. Taking into account the faster than expected growth and strong job gains, the bank judges that economic slack is now essentially absorbed. So this is the first time that they have said that the slack in the economy is absorbed, and we are more or less back to normal growth compared to pre-pandemic numbers, which was the target that they publicly set, saying that when this happened, that is when we would see interest rates start to go up. So we are now there, at least as far as this is concerned. So key messages: inflation is expected to decline relatively quickly to 3% by the end of 2022. So basically what they're saying is that with all the supply bottlenecks and with everything that's going on in the economy, and specifically with interest rates about to go up, they're expecting that the inflation by the end of the year is going to come back to normal numbers. Now, the question is, how quickly will that come? And later on down the line here, they talk about the fact that the consumer price index is expected to remain around 5% for the first half of 2022. So they're basically thinking that inflation isn't going to die out until the second half of this year. And it's expected to ease to about 3% by the end of the year. And then inflation is expected to decline to around 2.25% by the second half of 2023, and basically remain close to target over the next couple of years. Now, it's pretty clear the way the markets are reacting that it is quite possible we could end up in a recession sometime between now and then, especially as these interest rate moves start to have an effect on the economy. You have to remember that the Bank of Canada and central banks in general tend to operate in a lag of what's actually happening in the economy. So they're making decisions today based on data from December and then forecasts of what the year is going to look like. And as things change, they're going to have to change their stance. Or if things stay relatively the same, then maybe they stay the same. But what we know about economics and what we know about economies is that generally things don't stay the same. So expect that the forecast could change partway through the year. Now, while there's lots of graphs in this report, the one thing I found really interesting was this one here. Supply constraints and energy prices are pushing up inflation. And if you take a look at this and you look at energy and supply constraints, so supply chain issues, what you can see is going back to January of last year, energy and supply chain issues weren't having a huge effect. In fact, going back even further than that, you can see these blue lines here. This is where energy was actually helping the prices of things. And now what you see is as we start to get into current date, is the supply chain issues are the red lines here. They are obviously growing and having a really, really positive, or I guess negative effect, depending on the way you look at it, impact on inflation. And so too is energy prices. And this is expected that energy prices, I find it interesting here that in their forecast, they're basically suggesting that energy prices will start to play less of a factor. I'm not sure that's necessarily true, especially if we have a conflict with Russia and the US. But basically what they're saying is that for the next few months here, you can expect that supply chain constraints, according to their forecast, these three lines here, are still going to remain relatively high. So really the moral of the story here and what we're seeing is that the economy really needs to figure out the transportation issues and the supply issues. And once that happens, we should go back to normal. Now, there was this whole conversation about transitory versus not transitory. What it seems is that the economic picture indicates that transitory inflation is still relatively there. It is a thing that actually exists. It just took far longer than expected for the supply chain issues to figure themselves out. And by the way, they're still there. And as we see new variants and as we see lockdowns and so on and so forth, this could play a factor on the economy. Now, one thing I do want to show you and that I always find really, really interesting here is if you go down to the very end of this report and you have to scroll all the way to the bottom, the one thing I do love is that they always have the risks to the inflation outlooks. And they show basically 5 things being potential risks to the inflation outlook. One is the more persistent effects of the pandemic on confidence. So in other words, if the Omicron virus gets worse, if something happens where COVID gets worse and we go back into lockdowns, that could have a negative effect on the economy. More persistent supply bottlenecks and cost pressures could have an upwards effect on inflation, which could be a very bad thing. So hopefully we're not going to find ourselves in that situation. Reversal of growth in goods prices. So as supply starts to come back online and perhaps as demand starts to go down, we could see prices go back to normal, and that would obviously have a negative effect on the economy and a negative effect on inflation. Stronger household spending in Canada. So if more money is being taken out of savings and being put towards actual spending, then that could have an upwards effect on inflation. And then last but not least is sharp deterioration of global economic and financial conditions. So in other words, and they're pointing to China in this case, if things like the real estate crisis that's happening in China have an effect on lending and basically the ability for economies to be liquid, this could have a negative effect on inflation, and we could be in a lot of trouble if we enter a worldwide recession, thanks to the Evergrande crisis and things that are going on worldwide, as well as in other emerging markets and so on and so forth. So there's lots of things that could potentially impact the economy going forward here. As far as that question of variable versus fixed rates, which we talked about, and what you should be doing from a variable rate perspective, keep in mind, again, that fixed rates have already priced in the increases. So if you were to lock in right now, let's say you've got a 1.45% mortgage, and your lock-in rate is probably going to be about 2.75% if you look at a 5-year fix, maybe a little bit lower than that if you look at shorter-term mortgages. Well, you basically got 6 interest rate increases before you get 2.75. So if you were to go to lock in your mortgage right now, essentially what would end up happening is you would be locking in at a higher interest rate and not having the benefit of all the time that it would take to actually get up to that 2.75%. So locking in right now, for the most part, doesn't seem to make sense because there's still lots of bandwidth between now and when interest rates get that high where you would still be saving money. So not making a ton of sense. The other thing you have to keep in mind is if you're worried about interest rates everybody in Canada has been stress tested to about 5%. So there's nobody suggesting that we will get to 5% interest rates in the next 2 or 3 years. And you have to keep in mind that you've already qualified at 5% interest rate, which means you can withstand the higher interest costs, assuming that you aren't going out and blowing all of your money. The other thing you have to keep in mind is that if you were to lock in, let's say on a $500,000 mortgage, you're probably going to have about a $300 to $400 increase in your payments versus a quarter point increase is only about a $60 a month difference, or about $15 a week. So most people that have $500,000 mortgages are spending more at Starbucks than an interest rate increase would actually affect them on a weekly basis. So, you have to look at the numbers for yourself. You have to figure out the difference in the price between fixed and variable. If you want to pay that interest rate premium and that essentially insurance of interest rates going to 2.75 when you could have all of that time between now and when they actually do hit their saving money. And it comes down to personal preference, but the reality of it is most people are probably still going to do very, very well keeping their variable rate mortgages. Again, $15, $20 a week on a $500,000 mortgage. It's not a big deal from a money out of the pocket scenario. And if it goes up a bunch of times, well, yeah, you're gonna have to spend a little less money on Starbucks, but keep in mind again that you've qualified at a significantly higher interest rate and you should have the money available in order to withstand interest rate increases right up to the high side of the high interest rate increase predictions, which is about a 2% increase over the next couple of years. You can withstand that from a qualifying perspective. And again, if you've gotten a mortgage in the last 5 years, you're pretty much in a place where you should be able to withstand higher interest rates. And again, that old fixed rate versus variable rate conversation, I'd way rather see people gradually having their interest rate increase by 25 basis points at a time than have a 5-year fixed and basically get a surprise 5 years from now and having a huge increase in interest rates as they feel payment shock. So again, keeping as much money in your pockets as possible right now with your variable rate mortgages in case you need to subsidize your mortgage payments is always a good idea. There's other videos on this channel on exactly that called how to inflation proof your mortgage. And, ultimately stay put on those variable rates. I know people are thinking about it. They're thinking about locking in. Probably not the right time as of yet. We got to wait until those variable rates and those fixed rates get closer and then see what the economic picture looks like from there. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers. We'll see you on the very next one. Cheers.